Everybody, what's going on? It's Bill with Franklin Loan Center. It is May 24th. And just want to talk today about okay, so we've seen rates kind of creeping back up again. And one of those reasons is that this whole banking situation, crisis, whatever you want to call it, that's running behind the scenes. So the question becomes how does that, I mean, I guess banking and mortgage kind of, maybe people think of those as a bit in the same bucket, which they kind of are. But what's the direct impact here? How is this having an effect, right? And so I try to make this as simple as I can. And even there's parts of this that I don't understand at the deepest levels. But long story short, banks lend out deposits, but they do it on a leveraged basis, right? So they'll lend out 10 times deposits, right? So if all of a sudden banks have a bit of a run on withdrawals, so they have a bunch of people that want their cash back, then they're going to run out of cash right away, right? And that's what's been happening, right? And what's happened in a couple of cases is that word's gotten out that a couple of these banks like SVB, Silicon Valley Bank, what happened there is they kind of word got out that they were in a bit of trouble. And then what does everybody do? I mean, you hear that about your own bank. You're going to run to the bank and withdraw your money as quickly as possible, right? So that's a possibility, right? Where you literally just see a run on your bank, and then they don't have the liquidity to do anything to actually give those monies back. And so they end up upside down, illiquid, and the rest is history, right? They close their doors. It's one of the biggest bank failures in literally U.S. history. So, but now we fast forward, and there's other ways this can happen as well, right? I mean, so another situation is just look. I mean, there's a reality here that you keep your money in a bank, and a lot of these banks even right now are offering 2 and 3% for just totally liquid money. Maybe tie it up for 3 to 6 months or something like that. Well, you get the same. You can get a 5% return on a 3-year treasury note right now, So you go buy a treasury note, which has as low risk as possible, I guess, despite the looming, situation with the debt ceiling. But one way or another, that's another reason to withdraw money from the bank, right? And so it puts banks in this situation, and this is where it starts to tie to the mortgage side, is what banks have on their books to be able to raise liquidity, to be able to actually give these places that, these people their funds that they're asking to withdraw, is usually a couple of possibilities, right? One is that they've obviously got whatever liquidity they have on hand, but then they also have treasuries, which, by the way, are currently all underwater. And when those are underwater, but it's the only place they can get liquidity. I guess the second place they can get liquidity is by selling more stock, but all their stock prices are crap right now. So that's even hard to raise money that way. So what they end up doing is selling treasuries, and they sell them at a loss. But this is so treasuries are a bond. Interest rates are set by bonds, and what that does is it causes selling in bonds. They have no choice. They have to sell it, and they have to sell it at a price where they can raise liquidity right now. And so it just creates more supply into an area where bonds are just it's gonna bring those prices down. And when prices come down on bonds, rates go up, right? And so that's sort of what we're seeing right now. And you can see a few individual really big trades that are happening that are causing these sorts of fluctuations and upward moves in interest rates, right? So it's really just causing additional supply of bonds into the market, which is what sets mortgage rates. And so, long story short, that's really how it's having an impact, and it's a significant part of the reason that maybe we're not seeing these balances come down, or I'm sorry, the rates come down. And it's just another of the headwinds that we're seeing right now. So there is hopefully a not too confusing explanation from a bit of a layman, but I've looked into this and trying to understand it, and that's kind of what's going on, right? So what fixes this? And this is what puts the Fed into a weird spot. If the Fed started to either stopped increasing rates or started to decrease rates, then that could help the situation. But then The other side of that is have they already, kind of stopped inflation? So it's definitely a tough spot. It's another reason that like, hey, rates are where they are right now. I don't know how quickly they're going to come down. It's certainly seeming much more sticky than most of the experts that I listen to are thinking. So, but I really still continue to believe, I've been saying this literally every week, yes, rates are up, but it is literally, I mean, if rates come down and all these buyers are going to flood into the market, believe me, everybody I'm talking to is like, I like, with where rates are, I just don't want to buy. If rates come down and everybody dives into the market and we don't have a ton more inventory, we're going to have a real inventory problem on our hands, and it's going to just shoot prices up, and buyers are going to be helpless in that situation like they were a couple years ago. So it still, in my mind, means you should, if you're thinking about buying the next 6 to 12 months, now's the time. So hope that wasn't boring as heck and confusing as heck, but just want to kind of get that out there for everybody. Why are rates being sticky? This is one of the reasons, but take advantage of it because it might not last forever. So I'm Bill. I'm with Franklin Loan Center. Please like, share, comment. Any questions, don't hesitate to reach out to me or put the question in the comments.